We have Anuj Kapoor today. It was raised about $1 billion, that's 8,500 crores.
Back in 2015-16, we used to consume 14,000-15,000 residential units a year. The last year number has crossed more than 65,000 units. This year, last 2 quarters are a little slow. A lot of investor buying which was happening has tapered down. If I look at the supply side of it, that is one area of a concern. From here, the price appreciation might be more inflation adjusted.
Like what happened with Coca Paper.
Or even financial district for that matter. 6-7 years back, which was like 5,500-6,000 rupees a square foot a market. Today we are talking about upwards of. In a cycle like this, one also need to be little cautious as a developer, not get into the debt trap of it. NCR or Mumbai or Chennai. It has taken 5-6 years for these markets to recover.
How does a customer identify red flags?
The biggest point to look at is the lot of banks and institutions will approve the project for giving home loans. That doesn't mean that the project has funding. Toughest for developers to raise is the funding for the land.
So should one be alarmed if a developer is offering very, very low price?
I would say yes. But what needs to be looked at is
Hi everyone, for our 5th episode, we have someone who's raised about $1 billion, that's 8,500 crores, for the real estate sector. We have Anuj Kapoor today, the partner and founder of Upwisery, which is a financial and wealth advisory institute for different sectors, especially in real estate. They have really empowered that sector to a large extent. Hi Anuj.
Hi.
So if you could give us a little insight about your journey, and how the journey has been for you in the whole aspect of it.
As a firm, we are a 10-year-old firm. We started in 2014, largely to work with mid-market enterprises. And like you rightly said, we work a lot with real estate developers, primarily across South India, and help them in various financial strategies and raising funds from institutional and family office investors. So in the last few years, like you said, we have raised more than about $1 billion for at least 100 plus projects across South India.
So Anuj, I would, like I said, I would want to start with a very generic question first. Since you are the top view of how the funding is in real estate, I'm sure you understand how the market is currently, right? If you could throw some light on that, and what are your thoughts on that?
To be honest, Hyderabad real estate market has had a dream run in the last few years, especially in the last 5-6 years. And this was also a dream run because as a market, we had a very long lull patch, right from 2008 after the global financial crisis up to 2014-15 till nothing really moved in the city. So we started seeing traction, since 2016 onwards. And since then, I think the market has really taken to the new heights. If I can put it in, numbers for you, back in 2015 or so, 15-16, as a city, we used to consume about 14,000-15,000 residential units a year. That many new units used to get sold. The last year number has crossed more than 65,000 units.
Wow.
So, if you see from that perspective, the market has really, grown 4 times, similarly, if I look at the other asset class in real estate, which is commercial office real estate, we used to be somewhere in the range of about 40-45 million square foot of commercial A-grade office space in Hyderabad. Today, we have crossed more than 100 million square foot. In the last 7-8 years, we have added more than 55-60 million square foot of new office. That's a humongous number which got added, and that has also taken up the city's stature in terms of scale of the market to a different level. Now, Coming more specific to how we are reading the market today, obviously the market size has increased every year. The residential sales have grown. So 4 years back we were selling say 20 odd thousand units. Then it became the 20 became 30. 30 has become 45 year before, and then last year we had a great run. This year, last 2 quarters are little slow, I would say, but there are multiple reasons for that. We had a election season, so usually in those kind of events, a lot of buyers tend to go slow, and so last 2 quarters are a bit slow. But we have a very positive view on the market for a longer term this thing. Another point to consider, so demand side, I don't see much challenge, but yeah, lot of investor buying which was happening has kind of tapered down, which is in sense is a very good sign. And what you see today is largely the end user market. And which is a healthy sign for the market, because when you have a lot of investors buying into the market, typically it is a sign when where the markets can actually it's inflated, right? So end user buying is always a healthy sign for the market, and which is what we are seeing today. Now if I look at the supply side of it, that is one area of a concern, which I believe there's a lot of supply which got approved in the last few years. When I say supply, it means residential units which got approved under RERA in Hyderabad. And we have seen a lot of massive residential launches. But till now, it's still not in a situation where we should be worried extremely, because as the supply is increased, equally the demand had also kind of picked up. So it was balancing it out. We are seeing some signs of velocity of sales tapering down, and there could be variety of reasons for that. But at the same time, last few months, if you see, the supply has also got a little limited, because last few months the approvals cycle has gone a little slow. So no new projects launches we have seen in the last few months. But yeah, next few months we see a lot of new projects will get launched, and again the supply will catch up. So it is, if I can sum it up, in my view, it is a market where one need to be very cautious in terms of what we are buying, with whom we are buying, at what stage we are buying. It is not a market where I see that there will be a massive price appreciation from here to in a very near term, I would say. There's a lot of price appreciation which has already got captured in the market in the last 4 years or 5 years. And from here, the price appreciation might be more inflation adjusted or inflation rate related, this thing, till that new cycle comes in and another set of demand drives the market.
Okay. Yeah. So right now you would say it's stabilizing.
Yeah, so it is stabilizing, but at the same time, it depends what is the intent of buying. Like if somebody is buying it from an end consumption perspective, end user is buying for living perspective, then I don't see any challenge. They should look at good projects. They should look at developers who have a capability to deliver, and they can still continue in the long term. They will get good appreciation. But if the intent of purchase itself is from an investment point of view, and that too in a very short term, that I'm not too sure of how much of that price appreciation they will get in a very short term. In long term, yes. But where the current market prices are today, I don't see too much of an sudden appreciation or a very appreciation in a very short term, just because there's a lot of supply hitting the market.
Got it.
And once that kind of supply hits the market, technically, typically what happens is that developers do not have much choice to increase because of the competition.
Right.
So it would tend to kind of be in that range and increase like a nominal rate.
Got it.
Yeah. What we saw in the last few years, like for example, a few years back.
Like what happened with Kokapet?
Yes, what happened in Kokapet or even Financial District for that matter.
Yeah.
Financial District few years back, like 6-7 years back, used to be a market which was like say about 5,500-6,000 rupees a square foot a market. Today we are talking about upwards of 10,000 rupees a market, right?
Almost.
So this kind of jump might not be witnessed. In my personal view, people might have a different view about it. But yes, the normal increase what we see will continue to happen because the city itself will, has a lot of growth prospect, and that will continue to drive the market over a period of time.
But Anuj, since you raised, thousands of crores for the developers, what is the financial position right now of the developers and different types of developers? What is the current scenario?
So very interesting question. This last few years of a good run in the market has really helped a lot of good developers to go to a different trajectory of growth, if I can say so, and that has really helped them to strengthen their balance sheet. So the way we look at it, or for that matter, any financial institution looks at it, is we can categorize the developers into three categories: Cat A, Category A, B, and C. Category A developers would be people with a lot of good delivery track record. Let's say they've delivered more than 10, 15, 20 million square feet.
Like the big players.
The very big players of, like the My Homes of the world or Aparnas of the world. They are very large developers, right? They have a very solid balance sheet strength. They have delivered projects. They have made profits out of it, and they are financially very sound. And they also have a great capability now to raise capital from institutions, right? Then there's a second category of developers who would have delivered less. Their balance sheet sizes are small, but they have a good track record. And they have done a good delivery track record of say 5-6 million square feet. They have a decent, scale and size of the, balance sheet. But it's not necessarily that, they can raise independently on their balance sheet thousands of crores. They can raise few hundred crores, right? Then the third category is the Cat C developers, would be like a fairly new players in the market, possibly do not have that kind of financial strength or the credit, history. So these parameters need to be looked at. Now, what has happened is that across all these three categories, the game has really gone to the next level. The bigger developers have really benefited out of their projects deliveries, what they've done, and their balance sheet size have increased. Like if they were selling 1,000 crore worth of residential inventory every year, now they're selling 3,000 crore worth of inventory every year. So that way their capabilities of raising more capital, their balance sheet sizes have improved. At the same time, the same cascading effect has also happened with other set of developers. So last few years, lot of Hyderabad developers who were fairly had a very limited capabilities of raising capital through institutions has now gone very good. A lot of institutions have supported very early stage developers also. And now they are in a situation that they independently can raise more capital for bigger projects. So it's a I would say worked out fairly well for most of the developers. But in a cycle like this, one also need to be a little cautious as a developer that you don't take, because one should also not get into the debt trap of it. Like when the liquidity is there in the market and there are institutions backing you, you also get tempted to take more money to execute larger projects, which could be out of your appetite.
Okay.
And that is where you got to as a company, as a promoter, one needs to have that kind of financial discipline, that how much debt are you taking into the company's book, uh, against what is your repayment capability.
Otherwise, it could backfire in not a very.
And that is what has happened in a lot of markets. If you see the big real estate crisis, what other markets have gone through in the last from possibly from 2013 to 2019, whether you take NCR or Mumbai or Chennai, it has taken 6 years for these markets to recover, because when the market was good, a lot of developers scaled up very fast. They took a lot of debt on the books. And once the sales started tapering down, they were not able to service these debts to the banks. They were not able to repay back. And hence, it got into a loop where they defaulted on their loans, and they could not finish the projects. So it is also a time when everybody has to be a little cautious of how much capital they should raise on their books. It should be something which is suffices your capital requirement
With the delivery of
with the delivery, backing up with the delivery of it.
Got it. Because end of the day, you have a buyer
Yes,
which supports the payback of the debts that they have.
that's right.
Right.
So financial discipline is very important in this particular industry. And when the institutions start participating with developers and giving them funding, it also brings in a lot of discipline at the developer level, because financial institutions will ask them hundreds of things and to maintain, and certain accounting standards to be maintained, certain guidelines to be maintained, just to make sure that there is a financial discipline and there is a watch. Always there's somebody watching on your accounts as to how are you utilizing your money, and whether the money is being used for the project. So
I think RERA comes into picture for that.
RERA is a regulatory body which does that. But if the developer is working with the financial institutions, banks and NBFCs and lenders, they also keep a monthly watch or a quarterly watch on what's happening on the project level, to make sure that the money collected through the sales of the project is utilized for the project and not for some other purpose.
Got it. Or not exceeding the set expectation that was there.
So working with the institution also brings in that financial discipline, which over a period of time becomes the norm for. So the companies who have adopted this well, they are the ones who are able to scale and sustain them for a much longer period. The companies who fail to adopt this financial discipline, they over a period of time perish and
maybe went overboard in terms of debt.
Possible, quite possible. Those are the cases we have seen in multiple other cities. So to sum up, currently from an institutional funding point of view, there's a good amount of liquidity in the market. There are a lot of institutions available to fund developers in Hyderabad, but also it varies, what kind of funding. Like if it is just a project funding required for construction purposes, there are a lot of institutions across India who are contributing or investing with the developers in Hyderabad. But if it is something like a financing for the land, if developer is buying the land and they are looking for somebody to invest and help them invest and buy the land, there is a bit of a challenge because the number of institutions who can provide that kind of financing are very far and few in India. And logically so, those institutions primarily prefer to work only with the established developers.
Okay.
So what we have noticed is that for an early stage developer, it usually becomes tough for raising capital from institutional investors at a land stage.
Okay.
Right? Once they have built a track record of delivery of few million square feet, then it is easy for them to raise capital even for land stage funding.
Got it.
But for the construction purpose, post approval, I think even the early stage developers are able to raise capital, but the cost of capital for them would be different. If the bigger developers are able to raise that project financing, say at in the range of 10 odd percent, 10, 11% interest rate, for these smaller developers, they might be able to raise it at in the range of 13 to 15%.
Got it.
So it is costlier capital for them. But yes, there is a capital available in the market. And I think this is also a period where they are utilizing to build their credit history.
Got it. Okay.
So from that point of view, there is a lot of evolution which has happened in the market. And I think there's a fair amount of institutional capital available for decent set of players.
Okay.
Yeah.
Interesting. So I would like to start with the first part of our podcast, right? The customer's point of view. Like how can they evaluate a project or a developer, and more on what they should look at as a buyer, right? So there are a lot of projects where it gets delayed due to funds not being available.
Sure.
Right. So how does a customer identify that before buying a project and understand the red flags of a project?
So, very good question. I think what we always keep telling everybody is the biggest point to look at is the delivery track record of the developer, right? What is the pedigree of developer you're choosing? Price is just one factor of that decision making. A lot of people just go and look at what price they are getting and what discount they're getting. But in my view, I think that should be not the only criteria. The bigger criteria, the price will only become effective if the project gets delivered. If the project is not delivered, then what will you do of that price, right? So delivery track record needs to be checked. Second is not only delivery track record, but on-time delivery track record.
Got it.
How many projects they have done, how many millions of square feet they have delivered, what is the quality they have delivered in other projects. So it is worthwhile to visit some of their earlier projects and see what is the quality they have delivered. And
the time frame.
And
when they deliver.
On top of all of it, I think what is very critical to kind of evaluate and decide upon is to see where there is a capability to raise institutional capital at the project level.
Okay.
Right. There are a lot of people who do not have a credit track record. They have never worked with institutions to raise capital.
Okay.
They are fairly new into the market. They have come with the right intent, but when the cash flows of the project in a wrong market cycle goes for a toss, then they find it difficult to go suddenly raise the capital from institutions or banks to support the project. That is where the credit history of the developer plays a big role.
Okay.
Right? If in other projects they have worked with certain banks or institutions, they have raised capital, they have given the capital back, then they have a credit history.
But how does a buyer do they have access to it?
So, if you see you can always ask this with from the developer as to who are the institutions whom you are taking loans from.
Okay.
Today some of these developers are also listed. It is very easy to go and online and check their balance sheets, how they have funded these projects. At least for the listed entities, one can do that.
Okay.
I think it needs a little bit of effort to do that diligence, but it is fairly, you'll figure it out. This kind of information can be found out. Right? So there are two parts to it. What I am referring to is developers' ability to raise fund for project finance side of it.
Yeah.
What I'm not saying...
And that can only happen if they've done a due diligence before.
Yes.
project?
I'm not talking about whether there is a home loan available at the project. A lot of banks and institutions will approve the project for giving home loans. That doesn't mean that the project has funding.
Okay. I think people need to understand the difference.
That's
Okay.
right. Yeah.
Okay.
See, that is the retail financing. That is where they are saying that, okay, if you buy a unit in this project, I will give you the loan.
Right.
Right.
Yeah.
But at the same time, the developer, if developer has what we call as project finance, which is the money they raise for construction purposes, right? It is not necessary to raise for them. Like if they have had good sales, if they have fantastic sales at the launch of the project, they have collected good monies and all. A lot of developers don't raise capital, right? They follow the discipline, financial discipline, and they try to complete the project without raising any capital from any bank or institution for the project, because from the sales they are collecting and they are completing the project.
Right.
Right. So it is not necessary, but from a consumer point of view, it is important to invest with a developer where at least he should have an ability to raise that capital.
Got it.
If he has a credit history with banking institutions and a delivery track record, during the project's life cycle, if the project slows down for whatever reason, because of market reasons and all, they should have an ability to go to a bank and raise capital if the project requires. Having that mapping, is a little bit of an effort, but it is worthwhile an effort to do that.
Like a CIBIL score.
Yeah, it is like that. It is like that. If there are if some developer has a default history, let's say for example, it will be very difficult for them to raise institutional capital for the project, right? And for some reason, if the market kind of tapers down, people like them possibly will get stuck than somebody who has a capability to raise capital.
Got it. Okay.
So it's an important point to look at about their history of raising capital from institutions.
So say it's a new developer and a good developer, right? Me as a buyer, I am going to be a little apprehensive about, say, buying the property. So if I have to do it in a very superficial layer, right? To understand, okay, this developer is going to, say, deliver the project eventually and on time. Is there anything else that we need to keep in mind?
Yeah, so some of the checks like these, how much do they have funding in place for the project? I'm not saying that if they don't have, they should not go ahead.
And the customer can know that and know the current funding?
So you can always ask let's say project is launched, if they've already tied up the funding, you can always ask who's their banking partner at the project, who has given them the developer funding or project funding, right? So technically, if there is some backup there, then you know that some institution has done due diligence and has offered them money. Whether the developer uses it or not is a different story.
But they have that
They have that as a backup.
too.
Yes, they have that as a backup. Or if they have raised money for some other previous projects they have delivered. So I think, if consumer asks, I think the developer should be able to provide this information.
So should one be alarmed if a developer is offering very, very low price?
I would say yes. We should be very careful in those, those kind of offers. But what needs to be looked at is at what stage of the project that is being offered. So if it is, let's say, there could be different scenarios or situations where the developer is offering that kind of a discount, right? If it is a very early stage, let's say just at the land stage, there were a lot of pre-sale or offers which were floating around in the market in Hyderabad, say about a year and a half back. At that stage, if you are getting 40-50% discounts and all, which means is the developer is primarily raising capital from retail investors or retail buyers to either finance for the land or for the approvals or for, early stage of the project, right? But if the same thing is done post approval, like post approval, they are giving substantial discounts and things like those. It is relatively safer because you still have approvals for the project, you have RERA of the project and all. They could be offering that discount for a certain purpose to gain velocity in the market. Or so, what is the purpose with which the developer is doing that, and what stage of the project they are doing it? That is more critical in my view. If it is, let's say, the project is already 90-95% done, completed, right? It is at a handover stage, and for some reason, some developers offer 10-15% discount because their inventory is not moving very fast. So there could be a situation where they want to push the inventory out in the market and they offer some scheme and some discounts. At that stage, the risk is less. But if it is offered right at the very start of the project, where even the approvals have not come through and all, then obviously it is you got to really go deep and understand what is the pedigree of developer you are dealing with there, and what is the purpose they are raising this capital for.
Okay. Which brings me to, at what stage should one buy, which balances out the safety and the gains that one would get, right?
Yeah.
Should it be the beginning of the project or, when it's at the handover stage? So what would you suggest in that situation?
So ideally, one should, as a consumer, should always look at buying post approvals. Once you have approvals, once you have RERA registration, is when ideally the developers would typically launch the project. With good category developers, Cat A, Cat B developers, I think buying at an early stage also is not a problem. Because if they have a decent delivery track record, you would tend to assume that they would also do well in this project and they'll deliver irrespective of the market cycles. So I think it also depends on whom you are buying with. If I am buying, with a relatively unknown developer, right, then I personally would prefer to buy when the project is almost done. At least I have a fair view that, okay, this is the quality I'm getting, this is the timeline I'll be getting at and all. And that much of risk I can take. But with a larger developer recognized with a proven delivery track record, I think even post approval at the launch also is not a problem.
Gosh. So what percentage of, say, a property price should one take a loan? And what are the schemes that you suggest, one should go for?
Yeah, so if you look at the ask of most of the banks, NBFCs who offer home loans, I think majority of them would typically ask the buyer to put in the margin money in the range of 10 to 20%. I think if you go by the public sector banks and HDFC and some of these institutions, they will typically expect 20% of the property value to be brought in by you, and the balance up to 80-85% is what they can fund. Some institutions have a better LTV, loan to value. They can even extend up to 90% in certain cases, but they do it selectively. So I think that is mandatory. Any which ways you have to, as a consumer, bring in that much of capital. But beyond that, it is up to you. If you don't want to take the entire thing on loan, you can contribute 40% from your side, 60% from the institution. It depends on which interest cycle you are in and how much you are ready to pay for that money which the bank is providing.
So basically, it depends on the journey you are in currently as an individual when you're taking a loan,
That's right.
a housing loan.
That's
okay.
Right. Yeah.
So moving to a second part of the episode, developer's point of view. What are the different ways that a developer can raise finances for a project? I
think if I have to answer that, then what we need to do is to understand the whole project life cycle. Project life cycle, when I mean is that what stages the project goes through and where is the capital required. So the first biggest input material for a project is the land, right? You need to have funds to buy the land or tie up the land either from some landlord on a joint development and all. Then you need money for approval purposes. and initial money for designing and getting all the contractors in and, making the whole plan and filing for approvals. Approvals also is a decent amount of cost nowadays, so you need capital for that. And obviously from there it goes into the pre-launch phase where developers put a lot of marketing office and initial marketing expenses and things like those. Then they do the launch. Once they have approvals and launch, then obviously they need a project finance for the construction purpose. So these at all these stages you require capital from a developer's point of view, right? And this pool of capital is different. So the easiest for them or the cheapest for them is the construction finance, which is basically project finance. Once the project has approval and it is got launched, the banks and the NBFCs provide them certain amount of percentage of the total project cost as funding for construction, right? The toughest for developers to raise is the funding for the land. If they have to buy the land, they have to necessarily raise money either through their private sources, wherein some people can pool in money together and buy the land and things like those. Or if the developer is buying on their own, then they have to rely on institutional investors who would invest with them to buy the land. That piece of funding is the toughest and the costliest, because the very few institutions who do that.
Okay. So they get a part of the profits of the project, is it?
So it depends on variety of structures of how the deal, what kind of deal it is. Most of it is still in form of a loan. So the developers have to, so the institution would typically bring anywhere between 60 to 70% of the total land value. The rest, 30-40% has to be brought in by the developer any which ways, right? And on the 60-70%, they give a certain interest over a period of 3, 4, 5 years. So usually in the current Indian scenario, the minimum return expectation of these financial institutions for land stage funding is anywhere ranging from 18% IRR to even as high as 21-22% IRR. So it is a very costly money even for the developers. And the cheapest for them would be the construction finance, because by that time they already have approvals, they have some sales, so some risk is down. That this money comes, construction funding money comes from the banks, public sector banks, private banks, NBFCs. This happens in the range of about 10 to 12% interest rate. Or in some cases for small developers even at 13-14% interest rate. The money for land, the capital for land happens at a much higher 18 to 20% interest rate.
Wow, okay. Yeah. So what are the typical ways or institutions that they raise funds from, and how do they decide how much to give?
So it's very clear. It's bucketed into 3 parts. The usual project finance, which is money raised for construction purposes post approvals of the project and once the project is launched, can be given by public sector banks, private banks. A lot of NBFCs are there, a lot of home finance companies are there who provide this kind of funding. That is there are a lot of players. So there are certain institutions who do sub 50 crore funding. There are institutions who can write a larger check of beyond 100, 200, 300 crores. So depending upon the type of the developer, scale and size of the project, different banks and institutions can be reached out. What these guys are not allowed is to finance for the land. Okay. If the banks, public sector banks, or no bank in India is allowed to do the land stage funding. So for that, the new category which has emerged in the last few years is what we call as real estate funds or alternative investment funds in real estate. Right? These are basically funds raised with a specific purpose of lending money to real estate sector. And there are quite a few.
So Anuj, in your point of view, how does the entire financing of the project, the entire cycle, how does it close?
So, if I look it from a institution investor perspective, financial closure, they look at a very clear picture. Generally, if the 100 rupees is the cost of the project construction or total project cost, the banking institutions expect a minimum of 15-20% to be brought in by the developer, which is we call as promoters contribution or promoters equity into the project, right? Banks and financial NBFCs typically extend anywhere around 25 to 35% of the total project cost as project financing. Okay. And the balance 40-50% is what they expect the developer to generate cash from the sales.
Okay.
So generally it's like 20-30 and the balance 50 comes from the sales generated, cash flow generated from the sales. That's how they look at it. If any of these have a shortfall, then obviously either the sale has to cash flow from the sales have to pitch in for that, or the promoter has to bring in more money. But most of the banks usually work on a model where they kind of give up to 30-35% on the higher side of the total project cost as funding.
Okay. Yeah. So the cycle remains healthy, and wherever, say, there's a backlash, you can make up for it.
Yeah, and also this money is given at certain milestones. Now banks have kind of their way of structuring these transactions has also improved, considering their experiences across India in other cities and all. So it's not that this money is freely available to the developer. They will keep on tranches, and these tranches are linked to milestones which are related to construction, sales, and collection. So, and this is what I meant earlier when I was saying that they do a monthly or a quarterly tracking of the project. So if the developer had said that I will construct up to this much, so every month they have to report back to the bank that in the previous month, the 10 crores what you gave, this 10 crores got utilized into the project in this fashion. So they have to account for every money where the money is going for.
So this keeps the discipline in check as well.
That's right. To a large extent. Obviously, there are people who make, ways out of how to, take money out. But to a large extent.
Health, it keeps it in check.
Absolutely. And this also is a very healthy practice by institutions, because if the developer fails to achieve some of these milestones, either in terms of construction or collection or sales, they tend to, restrict the next tranche of money. So that will push the developer to perform better and cover up the milestone or deliver on the milestone. Then they will release the next tranche of money.
Got it. I think it's a good way to do it. It seems like a sensible process.
That's right.
Yeah.
That's right.
So, Anuj, what happens if, say, a project is not doing as well as a developer thought and defaults in paying the EMIs? What happens in that situation?
So, like I earlier said, now most of the banks and financial institutions have a fair amount of checks and balances throughout the journey of the project, right? So, they are doing this monthly or a quarterly tracking to ensure that such situations can be avoided, because if they don't keep a track and they keep lending money to the project, then eventually they will get into this default situation at a later date. So one is this tracking has really kind of brings in a lot of discipline that to happen. But like I said earlier, there could be situations where market has really tanked down, the sales are not happening, or for whatever reason, the project has got stuck. Obviously, for those situations, the financial institutions typically have a lot of clauses in their agreement, which protects their interest. Some of those could also be taking personal guarantees from the developer, so they can take control of the project. They can, at an event of defaults, they can take control of the project. They can induct give the project to somebody else, or they can, in most likelihood, they come back to the developer and ask them to refinance them or pay them back whatever monies are due through other sources, you know. So they try to kind of work around it. But if there is a situation where none of this is working, then obviously it becomes an event of default, and they can take the IBC route, and they file for insolvency and a lot of other procedural thing. But it's a very longish process in India, going through the NCLT route, recovery of their loan and all that stuff. So most of the institution would like to avoid it. They'll not like to do any of those unless it is, it's really gone to the
It's like in a really bad condition.
Yes.
So my last question is for all the developers who are entering the market, right? What is your advice in securing the finances? How do they go about it, and what is maybe top 3 suggestions that you would like to give them?
Yeah. I think top 3 suggestions. One is definitely making sure that they adhere to financial discipline, right? It becomes very tempting once you launch a project. It has got good cash and good sales. You start looking at new projects, tying up new projects and all. So I think that financial discipline, that the money, whatever is being generated through the sales, is utilized for the project, and so that the project completion is taken care of. Right. I think that becomes a very, very critical aspect. The second critical aspect, in my view, is also to, with a great intent, build the credit history. As a new developer, you might be doing a project which is doing very well and you don't need money in that. Still go and take a loan on the project. Okay. You take, instead of 20 crores, you get approved 20 crores, but you only draw 2 crores and repay that 2 crores just to maintain your credit history, right? Because in a good project, it is very easy to create that credit history, and you can, next time when you go for a loan, you can say that I took that loan, I paid it much earlier than the given timeline, and I honored the entire thing, whatever I said. So any good project is a good time to take a loan, even if you don't need it, to build your credit history. Yeah, to build your credit. And this is applicable more for developers who do not have a very long credit history. People who have already built credit history, they don't need to do this, right? So financial discipline, credit history, building the credit history is important. And I think third very important thing is also bringing in a sufficient amount of promoter contribution. I think where we are seeing a lot of projects do not get approved by financial institutions is where the promoter contribution into the project itself is very minimal. Now, the banks would typically, or the institutions would typically come back and ask us that you want us to fund you 30-40% of the project, wherein you yourself has brought in less than 5% of the project cost. So your skin in the game is very less. And if your skin in the game is very less, then the chances of default would be very high. So that's how they try to, protect it. And if I can add one more beyond the 3, what you asked for, last one would be possibly do projects which are more faster turnarounds, realistic in nature, like Hyderabad has unlimited FSI, and also it becomes very tempting for a lot of developers to do 50-60 floor towers and all, but they have a 7-year, 8-year long project cycle, right? So it might be better at the early stage, for an early stage developer, might be better to get into the projects where they can enter and exit the project in a short cycle of 2-3 years. Even if it is smaller projects, so that their delivery track record gets built in within the customers as well as the financial institutions.
So create a strong base.
And yes. And you also go through the life cycles where you can test out how to maintain quality, then scale up. The very first project, if you try to do a 5 million square foot project, then you get into the game and then you realize, okay, this is way too big for me to manage.
Right.
So depending upon their appetite and wherewithal, I think it makes sense to start small and then slowly scale up to a bigger set of projects. So that would be my, piece of advice to some early stage developers.
Anuj, thank you so much for coming on this episode today. It has been very, very interesting and very different and unusual episode for us. I'm sure, the viewers out there I'm sure there are a lot of people who want to get into development, and a lot of customers who want to buy a property have some clarity in terms of the financial aspect of it, right?
Sure.
And thank you so much. It's been a great episode for me, and a lot of knowledge is what I've consumed, and amazing.
Thank you for having me over. It was a pleasure interacting with you. Thank you so much.